system and procedure. So those are the elements of financial system. Then in addition, financial infrastructure. Relevant to different procedures and applications, it is important. So financial system, taking all the system, all the financial activities and financial institutions and some particular regulations, everything come under financial system. So financial market, that can be long term, that can be short term, or maybe capital, or maybe financial market, that is come under financial system. And as well as some particular instrument. So when you deal with some particular transactions, investment or maybe financing, it involves dealing with some financial instrument. So we have to learn that part also. And this procedure and infrastructure. In the financial system here indicate the financial intermediaries, financial markets, financial instruments, securities exchange, and central depository system. So any kind of economy consists of mainly two sectors. One is the banking sector, other one is capital market sector. In terms of the financial related things, one part is the banking operations, other one is the capital market operations. So likewise, other similar countries or other similar developing countries, Sri Lanka has a major part consisting of banking sector. Then the other part is the capital market sector. So capital market in developed market is sometimes the more sophisticated than the other sector. They have some certain standards, procedures, and everything. But in developing market or maybe emerging market, the capital market sector is comparatively not much developed. So banking sector is important. So everything, every transactions, every financial dealings done through banking sector. So banking bank side is the very important in developing country context. So here indicate the securities exchange. So any economy, there can be different regulators. Concerning finance, there are two main regulators. One is the Central Bank of Sri Lanka, main regulator, financial sector or banking sector. Then the concerning the share market, the main regulator is the Securities and Exchange Commission. Then all the capital markets and all the instruments, common shares or preference shares or maybe some other instruments are governed by, and the procedures and some brokerage companies, then everything governed by Securities and Exchange Commission. So in any country, Securities and Exchange Commission, we can observe only one exchange. Even in the US market, they have only one Securities and Exchange Commission. Even in the small market, they may have one particular Securities and Exchange Commission. So under one exchange commission, there can be different markets. For example, in the US market, New York Stock Exchange, then American Stock Exchange. Likewise, there are a number of exchanges. Then all the exchanges governed by main regulator, Securities and Exchange Commission. All the policies are taken by Securities and Exchange Commission. So in Sri Lanka, we have one Securities and Exchange Commission as a main regulator, and there is only one exchange, Colombo Stock Exchange, that is a one we have dealing with the share market, share transactions activities. So we can observe now, then main regulator is there, then sub-regulators are there. Colombo Stock Market is stock exchange is a sub-regulator. In the US market, Security Exchange Commission is the main regulator, and then American Stock Exchange, New York Stock Exchange, those are sub-regulators. In Sri Lanka, we have one sub-regulator, and in addition, there are some other supportive institutions, CDS, Central Depository System, as well as there are some brokers associations. Likewise, all the capital market activities are performed by that particular sector, capital market sector. In addition, we have other exchange regulator, Insurance Board of Sri Lanka. Insurance sector, all the policies, activities are governed by Insurance Board of Sri Lanka. So now we have in Sri Lanka, concerned financial sector, there are main three regulators: Central Bank of Sri Lanka, CBSL, Colombo Stock Exchange, and Insurance Board of Sri Lanka, IBSL, three regulators. Then concerning the stock market activities, stock market indexes are very important. In any economy, market indexes reflects their development level, maybe liquidity level, maybe market size level. Then stock market indices indicate their performance measures. Financial system. The term system in terms of financial system implies a set of complex and closely connected financial institutions, agents, practices, markets, instruments, and claims, financial services, transactions, liabilities in the economy. So it involves a lot of things. The system is the process by which money flows from savers to borrowers. So any kind of system, financial system, there should be one side is the input, other side is the output. So in financial system, we can observe one sector transfer some funds to other sector. Then there are two sectors. One is the lending side, other one is the borrowing side. Or maybe investment, other one may be borrowings. Likewise, there are different constituents participate in the capital market sector. So here indicate the different components. Banking sector regulations, Central Bank of Sri Lanka, then infrastructure, then capital market regulations, then different institutions, maybe financial institution, maybe insurance institution, there may be some other companies, listed companies, then markets, then instruments. So remember, those are the components of financial system. All of financial system is
Excuse me, sir.
Yes.
Sir, what is meant by infrastructure and instruments?
Infrastructure means that when you deal with some particular things, for example, if you are depositing some money or you are borrowing some money, there are some procedures. So if you go with some particular share market transactions, if you invest in the share market, there is a mechanism. Initially, if the corporations issue some shares, then there's a procedure. Then you have to go to a stockbroker, or sometimes you have to go to a particular banking institutions and you can deposit the money through some intermediary. Then after purchase your shares, you can trade your shares in the market, share market. Then in the share market, uh, they operate some operating system, trading system, mechanism. Then the Colombo stock market, we have automated trading system, depending on the demand and supply, and it decide the stock prices. So we have a automated trading system. That system is a one particular infrastructure facility. So if you say, for example, if you deposit some checks in the bank, so among the banking companies, they deal with different transactions. So every day, every uh, operating days, they get together and they they settle their dues. For example, if one banking company uh, uh, may have some deposits, check deposits, then from different banking institutions or maybe different people. Then other banking company also they have different uh, kind of interactions with the other banking companies. Some investors likewise. They settle throughout their system. Automated. They have some particular operating system, clearing system, check clearing system. So that is an infrastructure. Likewise, uh, if you are an investor, if you have purchased some shares, if you go to a stockbroker and you can deal all the transactions with the stockbroker. You can advise them to purchase and sell decisions or sometimes uh, end of the each month uh, on behalf of the different investors, the share market, one particular company, one particular depository, they provide some depository services to the investors. They take the custody of the particular certificates. They collect all the depositors' certificates, and end of the periods, they prepare some particular documents. End of the year, they transfer the particular uh, share transfers to other people. Likewise, every time the share register, when they prepare the company share register, then they renew their schedule registration. So until then, all the certificates are deposited in the central deposit system. So that is a one particular infrastructure facility given by CDS, Central Depository System. Likewise, there are a lot of different infrastructure systems. In the banking companies, they may have a call money market, interbank call money market. They have a procedure. So when the government issues some treasury bills and bonds, then there is a procedure. All the transactions are done with the primary dealers or licensed commercial banks. Then it has some particular procedure. So it involves some particular infrastructure. So however, the financial system, it provides mechanism by which funds can be transferred from those with surplus funds to those who wish to borrow. Hence act as an intermediary between surplus and deficit. So we can find here one side is the surplus unit, other side is the deficit unit. So between them, it provides the fund transfer facilities. So it provides the payment and settlement system. So if you are an investor, then if you purchase some shares, then in order to settle your dues, then it has some particular periods, days, 3 days, 2 days, likewise. T plus 2, T plus 3, likewise. Then there's a settlement system. And also finance system, it acts as a mobilize and allocate savings. It provides investor education. Sometimes Colombo stock market, they prepare some particular education system mechanism workshop in order to give the investors knowledge investment ideas, how they deal with the share market activities likewise. There's a systematic way, then it consists different transaction cost. When you purchase some shares, it involves some one element is transaction cost. That cost consists of brokers commissions, uh, CDS, Central Depository System, some particular charges commission, or maybe some other government particular taxes, CDS, the SEC charges, likewise. It consists different components. The percentage can be sometimes less than 1% rate transaction cost, maybe 0.25% likewise. So that small percentage consists a number of components. So, however, normally if there is a system, then it provides some low cost transaction. Financial claims and flow of funds. So, in the system, if there's a financial transfers from one side to other side, then it involves the financial claims. If you purchase some shares, then you have a claim. Then the company issues some certificate. Then that is your financial claim. If you deposit some money in the bank, then the banking company provides you some particular passbook. Then it is your financial claim. Then other side, there is a investment. When there is an investment, there is automatically it creates the financial claims. So between them, then we can observe the lenders or investors or maybe household sector. Then the other party, the borrower or investee, that may be a firm, that may be a government, that may be some other association likewise. So in between lenders and borrowers, we can observe the financial intermediaries, banking companies, financial institutions, leasing companies, stockbrokers, insurance companies. Those are the financial intermediaries. Sometimes if you are a government employee, then pension fund, then there is a particular financial intermediary. They provide some financial intermediary service. Then financial markets, maybe short-term market, maybe long-term market. If it is a short-term, we call that money market. If it is long-term, it is capital market. In a debt instrument or maybe common shares or maybe some other, any kind of instruments, it involves the in short-term market or long-term market. Then flow of funds, again, surplus units, other side deficit unit. You indicate the surplus unit, maybe householders, maybe business firms, maybe government, or maybe foreigners, different kind. Then the deficit unit, we can observe the same participants here, same household, business firms, government, foreigners. How it become the same party? For example, if once the government needs some funds, then they can issue some treasury bills. Then when the government issues some treasury bills, who are going to purchase that treasury bills? Maybe licensed commercial banks, or maybe primary dealer, or maybe some other investors. If you are dealing with the licensed commercial banks or primary dealers, you are maybe investors. Then the the person or parties who purchase treasury bill, treasury bond, then that party is the surplus unit. That may be a banking company sometimes, primary dealer. On the other side, then the deficit unit is the for the deficit. Maybe government. Government needs funds. Then to issue some treasury bills and collect money from the people, from the investors. Then they become the deficit. On the other side, when it completes that particular maturity time period, then what will happen? Then they have to, the government should redeem that security. So in that case, then the fund transfer from government sector to investors. Then in such a case, the government becomes the excess unit, surplus unit, then other party becomes the deficit unit. Likewise, there can be one location, so one time the business firms can be a surplus unit, other side, then the business firm can be a, again, same way the deficit unit. So if you deposit some money in the bank, what will happen? You are the person who supply funds to the banking company. Then you are the surplus unit. Then banking company is the deficit unit. Then you deposit some money. Then when you withdraw the money, then banking company becomes the surplus unit. You have become deficit unit. Likewise, the surplus unit and the deficit can be act accordingly. Then, yes, sorry, yes. Then when the banking company lends some money to some people, maybe for consumption purpose or maybe some investment purpose, then the banking company becomes the surplus unit, lender. In that case, you have become the deficit unit. And in between the markets and the intermediaries, we can observe. When the corporations or companies issue some shares to the public, general public, how they collect the money? Can you can you invest the money directly from the issuing company? You can't. So you have to go to a stockbroker, or sometimes you have to go to a banking company and fill the particular forms and deposit the money to the bank. Then the banking company provides some intermediate service. If the company issued some shares, then do they directly involve the issuing shares? No. Then they give some that role to some other parties, investment bankers. Then investment banker, they take that responsibility and they prepare the prospectus. They estimate some documents, the values like share prices, what are the values of the company assets, likewise, and then they provide some intermediate service. They involve the issuing all the shares to the general public, and at the end of the period, they can collect some commission. So they provide intermediate service. So all the banking companies, all the other related institutions, they provide the intermediate service. When if you are an employee, then from your side and the employer side, they contribute to the EPF. Then EPF, or maybe the central bank, or maybe some other institution dealing with that provident fund, they provide the intermediary service.
Is this the way used in the foreign countries also? Intermediate?
Yes, when dealing with the foreign market, say for example, if you are going to import some goods from the foreign market, how you are going to do that? First, you have to open a LC, no, letter of credit. Then the particular banking company open a LC account on behalf of you. Then you have to deposit some money, and then you have to make a particular order. Then when the goods are coming to the country, then you have to settle all the dues. So that part done by banking company, local bank as well as some other exporters bank in foreign market, foreign country. Then two banking companies in all that transactions. So when you do the investment in foreign market, that is also become like that. Through banking companies, they provide a service. Key institutions in the financial system: Ministry of Finance, Central Bank of Sri Lanka, banks, finance companies, leasing companies, primary dealers, money brokers, insurance companies, FCC, and Exchange Commission, and Colombo Stock Exchange, pension funds and EPF, provident funds, unit trust, securities firms. So those are the key institutions involved in financial system. Ministry of Finance, what rule they provide from the government side and the financial minister, then all the things are operated then that involve the Ministry of Finance. Then if the government issues some treasury bills, treasury bonds, then it creates from the they'll start with the central bank. Then central bank, the Ministry of Finance, they have some particular interactions. So when there is some other transaction like stock market operations, then SCC or CSC and the Ministry of Finance, they have some interactions. So when the Colombo stock market appoint their board of directors, commission members, then there is some particular regulation. There are some requirement. The board member should be appointed by part by the Ministry of Finance, other part by the particular industry sector, or maybe other part maybe from the brokers association. Likewise, there are some regulations. So they interact with other institutions. The Central Bank of Sri Lanka, main regulator. Normally, Central Bank of Sri Lanka involve monetary operations. All the monetary policies are taken by Central Bank of Sri Lanka with the idea of the government side. Then they may regulate all the banking sector activities, finance sector activities. They decide the reserve requirements. No, if the banking company operate their transactions from their deposits, they have to deposit some value in the central bank percentage. That percentage decided by the Central Bank of Sri Lanka. We call that reserve requirement. Then banking companies, some companies are commercial banks, some are savings institutions. Likewise, then finance companies, SCC and CSC, main regulator is SCC, and the CSC is the sub-regulator. Then when the SCC and the CSC appoint their board of directors, then there are some requirements. Then the primary dealers. Who are the primary dealers? When the government issues some particular security, for example, treasury bill, treasury bond, or maybe some other instruments, rupee loans, or maybe Sri Lankan development bond. Then primarily there is some particular people, institutions, they can involve purchase in that particular issue. Uh, that can be a licensed commercial bank or maybe that involve primary dealers. If you want to buy some treasury bills, can you buy treasury bills directly from the central bank? You can't buy directly from the central bank. We have to go to a licensed commercial banks, or sometimes you have to go to a primary dealer. Otherwise, you can't directly purchase from the central bank treasury bills or treasury bonds. Then some of the banks, they have taken the license. They have taken license in order to deal with the transaction with the central bank. Then some other particular institutions, uh, those are involve some primary dealing activities. For example, unit trust, maybe some particular thing, a particular primary deal, or maybe some other particular, say for example, Ceylon bank can be one particular security dealer. There is some other uh, primary dealers in the market. They directly do some transaction with the central bank. Then money brokers. So in the market there are, you know, that money brokers. So likewise the banking companies, the money brokers, they deal with some particular transactions with the people. Maybe purchase some dollars or maybe selling some dollars likewise. In insurance companies, that is also one part, important part in any economy. What is their role? Their role provides some insurance services to the people, investors. Maybe sometimes some particular life insurance related activities, or maybe sometimes the particular uh, company level accidents, maybe some other fire likewise. Then they deal with that particular services. Then leasing companies, they provide some leasing facilities to the people. Then pension funds, provident funds, pension fund, they collect the money from the different employees, employers, and provident fund also same. And from the collected money, uh, they can sometimes they can provide that funds to the government when the government requires some budget requirement, budget deficits. In such a case, the pension funds and the provident fund, they provide funds to the government. So when you retire from your service, then you can get some particular collected the invested money from the funds, pension funds. So other one is unit trust. So what is the role of unit trust? In addition to Colombo stock market, for example, there are some unit trust companies in Sri Lanka. They sometimes, if you are an investor, you are not going to invest the money, purchase some shares from the share market. You are not much facility sometimes. You are not enough knowledge regarding that. So in such a case, if you are a small investor, then you can purchase some particular units from the unit trust companies. Then their role is they collect money from the small investors, and from the collected money, they can purchase some shares, they can provide some funds to the government. Likewise, they deal with some financial intermediary service. Then from the invested money from different in different financial institutions, they get some commission charges. From their charges, ultimately, end of the day, end of the day, they decide what is the value of their unit. So if you purchase, say for example, from the normal national asset management company, uh, if you purchase some units at, say for example, one unit at 12 rupees per share, 12 rupees per unit, then after 2-3 days, sometimes you can collect that money from the unit trust company, deposit money. Then when you clear that, then the value can be sometimes maybe 12.5 per unit, or maybe less than that. Likewise, the unit trust companies, they involve some non-market operations. They involve some non-market operations. Then other one is securities firms, brokerage companies. If you want to deal with some investment activity, then you can go to a securities firms, stockbrokers, or maybe some other investment companies. Then relevant to bank finance operations, monetary policy. Monetary policy is the process by which a government, central bank, or monetary authority manage the money supply to achieve specific goals. Usually, the goal of monetary policy is to some part is missing here. So, however, the monetary policies are from the government side, from the Central Bank of Sri Lanka and the Ministry of Finance. They deal with that policy, especially the central bank. Depending on their different monetary policies, they act. They have authority. They decide the amount of the volume of money supply. So how to maintain the money supply? Do they have any particular standards? Sometimes, if you observe, concerning the economy, if there are excess liquidity, or maybe sometimes not excess liquidity, there are some limitations. In such a case, the central bank involve that particular thing. They assess the available money supply and the cash flows in the public. They decide the if there's excess cash in the economy, then the government can decide to, Central Bank of Sri Lanka can decide to collect some money from the people. Then they issue some treasury bills in order to reduce the available cash flows, available notes and coins. Otherwise, prices can be increased at a higher rate. So in some other cases, if there are some limitations in the economy, no much cash available, then due to that reasons, there can be some other limitations. There can be not sufficient investment in the economy, or maybe the product prices can be some issues. In such a case, government can decide to issue some funds to the public. Then they can repurchase issued shares, issued treasury securities. So that part is done by central bank, monetary policy part. Objectives of Central Bank of Sri Lanka through the implementation of monetary policy as per Money Law Act of 2002, the strategic objectives of the Central Bank of Sri Lanka are economic and price stability, financial system stability. Nowadays, we can think of how it implementing from the government side, whether we can maintain economic and price stability. Nowadays, all the things are going at a higher rate with that money supply. So can we expect some price stability? We can't expect. In such a case, the finance system stability, that could be some problem. In the government decide to some particular things like if the government is going to charge some particular excess taxes on the one-time charge to the some particular companies. In that case, what will be the relevant to the financial system stability? In there are some particular market issues, there can be some financial system stability. So if the government decides the different reserve requirements, then it impact on the financial system stability. How does the Central Bank of Sri Lanka do it? Through the implementation of monetary policy conduct, policy rate, open market operations, and other instruments. Monetary policy can be implemented. So main thing is the policy rate. The government can decide the interest rates. They can decide the repo rates, reverse repo rates, likewise. Through that particular rate. Then the other one is they can implement open market operations. Nowadays, you can think of what kind of operation we can observe, discuss here. Dollars, do we open the market for dollar exchanges? Some limitations. Open market operations, if we allow all the transactions taken place automatically, depending on the demand and supply, then the price can be sometimes very high, sometimes maybe can be decreased likewise. So the market gives some particular constraints, impose some conditions. Government can decide the particular rate. So what will happen then there's a particular requirements, constraints are there, then there can be some impact in the market. Even if the government decides the dollar rate is the 205, can you purchase at that price? You can't do that because no one is willing to supply at that particular value price. But the other side, black market, then they can you can buy that dollars at some particular higher rate. You can sell it to if you have some dollars, you can sell it at higher rate than the banking companies. Then black market operations can be taken place in such a case. So nowadays, we can observe the huge spread between the black market and the government side price. Depending on the policy rate, if the government decide to particular, say for example, reserve rate, from all the deposits, banking company should deposit some value in the central bank. That rate is decided by the central bank. Then if they increase the reserve rate, so what will happen? then from the general public to money goes to banking sector, the central bank. Then if the government decides some particular lending rate, increase the lending rates, so no one are willing to borrow at some higher rate. If the rate reduced by the government, what will happen? All the investors, all the people are tend to borrow money the government side because the rate is very low. That facilitates investment in the economy. Likewise, repo and reverse repo. What is the reverse repo? What is the repo? Repo means here repurchase. In short form, we call that repo. So, what is the meaning of that repo? For example, if the government has issued some particular security, treasury bills or treasury bonds, maybe say for example treasury bills, the government has issued some 3-month treasury bills to the public. To the public means the through primary dealers. In such a case, if there is an outstanding amount, the general public subscribe that dealings, then issued treasury bills. While this particular 3 months period, if the government wants to reduce the available cash flow in the economy, because the government thinks that there's a much excess liquidity in the market, the government wants to reduce that amount level. In such a case, government can decide to repurchase that particular issued treasury security, because they can't purchase directly, no, because if they have issued 3 months treasury bills, within 3 month period, they can directly repurchase that. They can decide to repurchase on some particular agreement. If the particular time period is not completed, not 3 months period completed, in such a case, government can repurchase that issued treasury bills, maybe within the 2 months period. If they want to purchase that, then they can repurchase at some particular higher rate with some particular agreement. That agreement is called repurchase agreement. Likewise, the government can want to implement the opposite of that repurchase. Then that may be reverse repurchase. In any case, they involve at some particular rate. Treasury bill rate may be 5% rate, but when there's a repurchase rate, then that rate may be 5.2% rate likewise. Not only the open market operations, as explained earlier, if the government wants to issue some, they can issue some treasury securities from the open market. They can collect the money from the people, likewise. So here you can realize now repo rate and the reverse repo rate. If the government issued at some particular rate, treasury bill, they say for example 5% rate is the government particular rate, treasury rate, 5% rate. When the government wants to repurchase that, no one willing to settle that dues at a 5% rate. In such a case, government decide that rate is more than that, more than 5% rate. Then the investors, they decide to share with that. Then they are willing to give the settle that things at a higher rate. more than 5% rate. Another one, financial institutions. Financial institutions are the business organizations that act as a mobilizers and depositories of savings. It consists of two types: monetary banking institutions, which include central bank, commercial banks, cooperative banks, etc. Another one, non-banking of financial infrastructure here, payment and settlement systems. Act number 28 of September 2005. Equity trading system, CSC, Central Depository System Private Limited. So normally that equity trading system handled by CDS, Central Depository System Private Limited. That is subsidiary of Colombo Stock Market. Then other infrastructure facilities, check imagine and truncation system, CIT. The interbank checks clearing system that is done by Lanka Clear Private Limited. Then other part is the financial infrastructure funds, financial infrastructure fund transfer system, Sri Lanka interbank payment system, slips for bulk batches, common electronic fund transfer system, transfer slips, CFTS for individual below 5 billion. So likewise, there are different kind of fund transfer system here. Regular authorities, the scriptless security settlement system. So if the government issued some treasury bills or treasury bonds, sometimes if they decide to issue it without issuing some certificate, deposit certificate, then that is called scriptless security settlement system. Scriptless securities. Without issuing some certificate, but through their network, they can handle all the transactions. That part is done by Lanka Secure Private Limited, settlement of government securities. The other part is the Foreign Exchange Act number 12 of 2017. Foreign Exchange. Then Finance Business Act number 42 of 2011. Regulatory authorities, as this mentioned that there are three main regulators, Central Bank of Sri Lanka, then Securities and Exchange Commission, Insurance Regulatory Commission of Sri Lanka, IRCSL. So Central Bank of Sri Lanka, the regulations and supervision of banking institutions is mainly governed by Monetary Law Act number 58 of 1949, the Banking Act number 30 of 1988, and the Exchange Control Act number 24 of 1953. The second one is the regulations and supervision of finance companies is undertaken in terms of the Finance Company Act number 78 of 1988. Then another one is the regulations and monitoring of finance leasing establishments is conducted under the Finance Leasing Act number 56 of 2000. The regulations of supervision of primary dealers in government securities is carried out in terms of local treasury bills ordinance number 8 of 1923 and the registered stock and securities ordinance number 7 of 1937. So if the particular private company or public company issued some common shares, before issuing the common shares, they have to register according to Register Stock and Securities Ordinance number 7 of 19. What is the difference between the Ordinance and Act? So, Ordinance, we call that in single Aanyapanatha. Act, we call that Panatha. So, before 1948, we had some ordinance, Aanyapanatha. But now we have only Act, not Aanyapanatha, Act, Panath. So that is the difference actually. So independence, we had ordinance. But after that, we have Act. Second one is Securities and Exchange Commission, SEC. SEC is responsible for licensing and regulating stock exchanges, stock brokers, stock dealers, and unit trust companies in terms of Securities and Exchange Commission of Sri Lanka Act number 36 of 1987. So normally the Security and Exchange Commission, they provide some licenses to the brokers or some other required parties like companies when they issue some shares. Then their main role is regulating the stock exchanges. Now, Sri Lanka, we have Security and Exchange Commission. So, their regulator, stock exchanges, we have only one, Colombo Stock Exchange. Then all the activities by the Colombo Stock Exchange are governed by Securities and Exchange Commission. Stockbrokers, their activities are governed by FCC Act. The stock dealers, in Sri Lanka we don't have stock dealers, but in some other developed markets, they have different stock dealers. Unit trust companies, we have unit trust companies. That part is governed by the Securities and Exchange Commission. The other one is insurance sector, Insurance Regulatory Commission of Sri Lanka. IRCSL regulates and supervises the insurance industry, insurance companies, and their agents, and insurance brokers under the regulations of Insurance Industry Act number 43 of 2000 to safeguard the interest of policy holders. Even if there are different insurance companies, they provide some insurance facilities to the public. Then we can observe much difference concerning the insurance policies. They do their insurance business separately, but with some particular modifications at some particular reasonable level. Otherwise, all the insurance companies provide the similar service. Financial intermediaries. Financial intermediaries refers to the activities of channeling funds between those people or institutions who wish to lend and those people or institutions who wish to borrow. Then financial intermediaries, then maybe individuals or institutions which bring borrowers and lenders of funds together to trade. So what will happen in the other market, commodity market? So here, lenders and the borrowers can be uh, involve their transaction in one particular place. If it is a banking company, the depositors and the lending things are done in the same place. Uh, in commodity market, in the stock market, the investors and the borrowers, investors and buyers, they involve their transactions through some network, through some stockbrokers. So in that case also, they bring all the investors and the buyers to some particular place. Stock market trading flow is one particular place. In other cases, through some particular system, network, you can involve that transactions. Financial intermediaries and aid in arranging financial transactions between surplus units and deficit units. Banks, as the main financial intermediary, provides most of financing activities from underwriting to uh, underwriting shares to the issuing of bonds. Individual company or maybe investment companies do that particular activities service, maybe sometimes from underwriting to issuing some shares, issuing some bonds. Types of financial intermediaries. One is the commercial banks, major suppliers of short-term and medium-term loans to businesses for various purposes, accept time deposit and demand deposits. What is time deposit? What is demand deposit? If you deposit some value in the bank for some longer time period, maybe 5-year period, maybe 1-year period, maybe sometimes 2-year period, then this is what time deposit, fixed deposits. In other cases, you can deposit your money and anytime you can withdraw that. Then we call that demand deposits, savings bank, savings account. Provides these funds as loans to individuals, businesses, and government. From the collected or saved money, they lend to other people, maybe government, maybe individuals, maybe some other businesses. Second type is investment companies, include mutual funds and real estate investment trust. Pool fund from many savers and invest them in various type of assets. Normally, the unit trust company, they collect money from the different investors, small investors, and invest their collected money in various purposes. Then investment bankers, Some companies involve some investment banking companies. They provide some service to the particular public companies. When they issue some shares to the public, then they involve that. Investment banking roles. Then pension fund. Pool pension contribution from employers and their employees and invest them in a variety of financial assets. Insurance companies, the premiums collected on insurance policies are invested in a variety of assets. The proceeds from these assets are used to pay claims against insured events or losses such as death, disability, accident, fire, etc. So how many insurance companies normally in Sri Lanka? How many companies listed in the market? Maybe 20 insurance companies, but some of the insurance companies are not listed. Some of the insurance companies are listed in the share market, Colombo stock market. If they do their businesses, insurance activities, transactions, normally if they perform better way, then they should list their shares in the Colombo stock market. Because they have, when the listed if companies are listed, then they have some particular mechanism. When they operate the activities, they have to perform some particular way, standard procedures are there. They have to submit their annual report to the CSC. Then sometimes quarterly report they have to submit that. Then they have some particular requirements. They have to follow that. These companies raise funds by issuing their own debt by borrowing from commercial banks. These funds are lended out to individuals and businesses. Finance companies also play a big role in the economy. Normally, their rates may be a little bit higher than the banking sector companies, but they have to maintain some particular procedures. They have to adhere to central bank regulations. Brokers. If you are an investor, you can't directly trade your shares in the market. You have to go to a stockbroker. You have to register with them. You have to open an account with them. Then the brokerage company, they provide some facility. Then other part is the financial market, money market, equity market, foreign exchange market, private debt securities market, government security market. Like there can be different kind of markets. You can say sometimes the treasury bill market. What is that market? That is a money market because the time duration is less than 1 year period. If it is a equity market, then that is a capital market because the equity shares are issued for a longer time period. Foreign exchange market, that may be short term. Foreign exchange market. Private debt securities market, it may be long term, that may be short term in the government public company issued some debentures, bonds likewise, then that may be a long-term market. Or maybe sometimes the particular companies, this non-banking companies take some deposits, issue some notes, promissory notes. We call that commercial papers. Then that is short term. Private debt securities market, but that is short term. Government securities market. When the government issued some treasury bills, treasury bonds, then that may be short term, that may be long term. Likewise, we can observe different kind of financial markets here. In addition to this, there can be some other market like mortgage market, primary mortgage, secondary mortgage, likewise. No, then we can find different kind of markets. We can observe in our economy there are different kind of markets. Sometimes the unofficial market may be there. Some people lend money at some high rate, at some monopoly. Huge, the transaction can be huge amount, but the rate also very high. Some markets are organized, some markets are not organized. For example, Colombo stock market, that is an organized market. There are sellers, there are buyers. Then in some markets, not organized market. For example, if you can invest some shares in the market through some networks, dealing with some instruments and networks, you can purchase some shares. Then, in that case, we can observe the physically located market. In the US market, they have some particular market. That value of that market is more than the organized market. We call that negotiated market. Organized market, other one is the negotiated market. The Colombo stock market is a organized market. Likewise, if there are some other markets, that may be negotiated market. Hello?
Hello.
Yes.
Actually, when we talk about there is something called transfer the money using undial method. What about that? It's not a market, it's only change.
Yes, very important. That market is also not organized market, not organized system. The undial system, that can take place in everywhere. No, but why? What is the reason for that? That operation occurred? Because if they transfer their funds through that particular system, banking companies, that sometimes they have to make some cost. Sometimes it takes some time. If it is a undial system, directly if you have some particular operations, then immediately you can use that funds. No, instead going through that particular system, then automatically, immediately, you can implement that. That is also unorganized market. There is one thing. There are a lot of things not coming through the system. So likewise, that the government now recently impose some conditions. if foreign income is there, then they have to convert that foreign income 100% cash. Early, the requirement was some particular, that particular conditions, maybe some particular at particular rate. So what will happen? So some people, importers and exporters, sometimes they are not willing to convert their foreign currencies at the same time. They can maintain some particular funds because they involve every time foreign transactions. So they have some foreign currencies. But now, if the government impose some conditions, if you have some funds, foreign income, then you have to convert into rupee values. What will happen? Then the people, they realize that is very unfair to them because they can manage their transaction with the foreign currencies easily. But if they directly convert into rupee values, then for the next transaction, they have to again deal with that foreign currency. They have to purchase again the foreign dollars likewise. They're not willing to involve the 100% conversions. There is some other conditions imposed by the government side. Due to that reason, then there is less dollars coming from the foreign market. There is one particular, you know, that you can't criticize, but they have to realize the truth. The foreigners and normally the importers and exporters, they do some transactions with the foreign institutions, foreign markets. So every time they have to have some foreign currencies. They have to maintain that. Otherwise, the operations can't be taken place immediately. Types of market. Market, any organized system which facilitates for meeting buyers and sellers. Then Colombo stock market, trading flow is an organized system. And sometimes if you say that in the commodity market, you can say Sunday polar, Monday polar, likewise, no? It's an organized, physically happening in that market operation. The second one, market may exist in a specific physical locations or not. The market can be physically located or maybe not. Another stock market is a physically online. Then it involves some online transactions. We don't observe the physical located things. So in some other market, there may be the market is not physically located. In the US market, they have one system. We call that negotiated market. We discussed that part is so. Then money market. Market for short-term securities having maturity less than 1 year. Treasury bills, commercial papers, some promissory notes. Likewise, the savings, those are monetary market related. Interbank call money market. Between the banking companies, within the shorter time period, they need some short-term requirements, short-term fund requirements. In such a case, they do their transaction between the other similar banking companies, we call that interbank call money market. Interbank call money market. Then other one is the short-term market, treasury bill market. Then commercial paper market. Non-banking companies, for their requirement, they issue some commercial papers. Interbank foreign exchange market. So if you are exporting some goods from the foreign country, then you have to open LC. The banking company, they deal their transaction with some other foreign exporter. There is some other bank in the foreign market. Then it is not the interbank foreign exchange market. So that transaction taken place in some other foreign currencies, dollars, yen, etc. Another one, capital market. Market for long-term securities having maturities greater than 1 year. Treasury bond market, corporate bond markets, equity market. The government side, they issued some bonds more than 1 year period. They issued some as a treasury bond. Then the public companies issued some bonds. Those are called corporate bond markets. In Sri Lanka, normally around 15 banking companies issued corporate bond. No other companies, other manufacturing, trading, or any other company issued the bond. Only that is limited to banking companies. The equity market, if the companies issued some shares that involve in equity market, then normally common shares are issued at no time duration. For a company, they raise capital, issues equity shares, that is for a longer period, no time period indicated. But that equity shares can be transferred to other people, other parties. That is very important. So anytime, if you purchase some shares from the shares of the particular company, anytime you can purchase from the market or somewhere when they issue at initial time, you can purchase that. But you don't need to maintain for a longer time period sometimes. You can transfer to other people. You can sell it to other people. Primary and secondary market. Primary market are markets that involve new issues of securities and hence provide direct flow of cash to the issuing entity. Primary market that can be taken place two kinds. One is as an initial public offerings, issuing equity to the public for the first time by a company. If new company issued some shares to the public for the first time, we call that IPO, initial public offerings. If the available company, if they have issued some shares to the public, they can issue additional shares to the public. In that case, we call that season offering, SCOs. Is simply selling more stocks by a firm is already publicly traded. For their requirements, additionally, they can issue some additional shares. Yeah, authorized capital, normally they don't issue at first at once. Authorized capital can be issued at different time periods. Secondary market, a market for the securities issued already. If you have some shares, if you have purchased some shares, then your shares can be traded in the some particular place, Colombo stock market. Then that market is called secondary market. Secondary market exists for the trading of common and preferred stock, warrants, bonds, and put and call options. Then the secondary market can be for different kinds. We indicate the common shares, trading of common shares. That is more popular market in Sri Lanka. Preferred stock, preference shares. Do you have preference shares in Sri Lanka? No, any company issues preference shares. Only we have now common shares. Warrants. When the companies form their businesses, initially then the company issues some warrants. Then warrants can be converted into shares later period, or sometimes they can maintain as a warrant. Bond. As a debt instrument, the company can issue some securities, bond, corporate debentures, etc. Government also can issue some bond, treasury bond likewise. And put and call options. What is put and call options? One other kind of security is options. Some options are put options. Some options are call options. So here, by meaning here, options means their value derived from something else. If the particular company issued some options, their price can be dependent on something else, maybe depending on the stock prices, common share prices. Or maybe if the issuing entity issued some options, their values depends on the something else, like harvesting. In the US market, they issued some particular options. Their values depends on their harvesting. So likewise, we can create that options depending on our paddy and some rubber, coconut, or some other garment products likewise. But the options can be two kinds. One is put options, other one may be call options. What is put options? If you purchase some options, it will have some two features. One may be put, some may be call. If it is put options, the purchaser, the investor, they have a right to convert that options into common shares likewise. We call that put options. The buyer has right to convert into something else. Maybe, for example, common shares. Then the other one is the call options. If you have purchased some options, so the issuing entity, not you, but issuing entity has some right to convert into cash or something else. Then that is called call options. If the issuing entity has issued some particular 5-year options for some particular time period, before that 5-year period, if they want to clear that investment value, then they can purchase that. Then they call that call options. They issued their options as a call options. That type of market, secondary market for equity shares, common shares, preferred stock, and warrants are traded. Normally in the market, in the equity market, secondary market, they perform the transactions for common shares, preference shares, and warrants. option markets. Option markets are involved in an option process in a specific physical locations. Option market. There are two parties involved in that. In the option market, in the Colombo stock market also option market. There are sellers, there are buyers. Depending on their orders, their demand and supply, the price can be decided. But, nowadays, we have an automated trading system. Even if it is an auction market, we have a particular trading mechanism. But early days, we had not that particular automated trading system. In that case, we call that the option process are carried out physically. We call that the transaction done by now automated system, early outcry system. We call that Handanaga Lansutabim. We have some particular trading mechanism. Now, stock market is a automated trading system we have. Another market is the negotiated market. Negotiated markets are involved in a network of dealers who make a market by standing ready to buy and sell securities at specific prices. Negotiated market involves the over-the-counter market. We call that over-the-counter OTC market. So that market is the negotiated market. This market is we can observe the physically located negotiated market. All the transactions done through network of dealing. Negotiated market or over-the-counter market, in short form we call that OTC market. So this is the unorganized market. Option market, that is organized market. Colombo stock market is organized market. Then in US market, Amex, NYSE, those are organized market. But in addition to that organized market, in the US market, they have a huge unorganized market, negotiated market. So we can see here the transactions not handled on an organized exchange are handled in this market. In some case, in any market, if you want to trade your shares, you have to fulfill some requirements. Colombo stock market also same. You have to maintain your that particular listing requirements. One requirement is you have to maintain some minimum share capital. Then you have to submit your accounts annually. You have to publish annually. You have to submit reports semi-annually or quarterly. Likewise, you have to adhere to different conditions. So likewise, in some case, say for example, one particular company, due to any particular reason, they can't publish their shares. They can't publish their report. They can submit to the SEC particular documents. What will happen? Then the SEC, they decided to suspend from the market for a temporary period. Until they fulfill their requirements, the SEC, they decided to suspend their the trading shares for a temporary time period. In the news, you may have heard that things suspended shares. So why? So they suspend due to that not fulfilling that listing requirement. So in such a case, that kind of companies, their shares can be traded in negotiated market, unorganized market. Like the dollars, black market, they perform their transaction at higher rate. Likewise, the that particular company shares can be traded in unorganized market. So that depends on their value, their company nature of the company. Their they have some particular ability. In some cases, if they do their transactions within that negotiated market, then they have some particular price mechanism system. Depending on their demand and supply, their prices also decided likewise. In the US market, negotiated market, they have a particular system like our automated trading system. US market, they have automated trading system for unorganized or unlisted securities. Negotiated market transaction, they can maintain the particular system, price mechanism system. We call that NASDAQ, NASDAQ. So here indicate this market essentially handle unlisted securities. If you can't fulfill the listing requirements, then that shares can be traded in that market, or securities not listed on a stock exchange. If you have any questions, you can ask. In the US market, OTC trading includes trading stocks of small and relatively unknown companies. In the US market, normally in the negotiated market, there are huge different companies. Some companies are very small companies. Some people sometimes very unpopular, unknown companies sometimes. Sometimes there are large companies. Sometimes here the one thing is that some companies they can fulfill the listing requirements in organized market like Colombo stock market. They fulfill the listing requirement. They submit their annual report. They submit their semi-annual report to the SEC. Likewise, they can maintain the minimum share capital. Likewise, they fulfill the listing requirement. But they are not willing to trade their shares in the organized market. Why? Because due to the competitions, there are large companies are there. Some companies are very established companies. Likewise, due to that competitions, sometimes they are not willing to trade their shares in the organized market. In such a case, they fulfill the listing requirements in the organized market, but their company shares are traded in not organized market, but negotiated market, over-the-counter market. Because of that different nature of that particular things, like unknown competitors. some people are not willing to trade their shares in the organized market because of the market may give the less price, likewise. Due to that reasons, the organized market, organized companies, the particular companies, they fulfill the listing requirement in the organized market, but they are not willing to trade their shares in the organized market. In such a case, they can trade their shares in the negotiated market. Actually, we call that a third market, actually. Price quotations on OTC stocks are available from NASDAQ. They have a particular association here, automated quotation system of the National Association of Securities Dealers. That system is called NASDAQ, National Association of Securities Dealers Automated Quotation System. Their prices depend on the demand and supply. Even though they have didn't have the particular organized market, but they have a trading mechanism. The OTC market does not have a specific location like organized exchange. It consists of network of dealers linked together by communication devices, including latest equipment. These dealers conduct transactions directly with each other and with customers. They directly involve with different dealers, investors. But in Sri Lanka, we can't do that. We don't have dealers. If you want to trade your shares, you have to go to a particular stockbroker. You can't do stock dealing. In other market is call market or continuous market. But it's call market. Sri Lanka, we don't have OTC market because unorganized, unlisted securities we can't trade in that other market. Temporary, we impose some temporary conditions suspended from the share trading, but immediately we have fulfilled that requirement and we can trade shares in the market. Then call market, continuous market. Call trading is restricted to a specific period of time. Continuous market, anytime when the market is open. So, can you say that Colombo stock market, which market? Is that call market or continuous market? That is continuous market. All the weekdays from 9:30 to 2:30 p.m., all the transactions are done in the market. All the tradings are taking place. Then we call that continuous market. But if it is a call market, sometimes the particular companies, they can decide to decide some particular event. In that case, until they fulfill that event, the market can be opened. Then that market is called call market. Until they collect the money, all the requirements, the required funds, then market can be opened until they fulfill the requirement. That market is called call market. Yes, now it should be the break actually. Now time is, I don't know. we can stop for 5 minutes. And I will. Now time is 3. We can 5 minutes break, 5 or 10 minutes. Now we can start again. Relevant to international market, in financial management, we are concerned about the cross-border transactions. So if you are involved in some import and export activities, then it involves some international markets, financial markets. Companies have more opportunities in international market for borrowing at a lower cost and list their commercial stocks on international exchanges. Now, here we concern the investment in other market. If you want to invest money in foreign market, shares in some other countries, then get involved in international financial market. Sometimes if you borrow some money from the foreign market at a lower cost, that may be international market. The problems faced by the firms engaged in international financial transactions, fluctuations of foreign exchange rates. If the demand for your local currency is very less, then there can be price reductions, depreciations. Different governmental regulations and tax laws. The different government may have different regulations. Sometimes regarding your investment, the different governments, they can impose some conditions. Sometimes from your investment income, they can charge some tax, different tax rate. Different business practices and political environment. Then different market may have different practices. Then the political environment also may have different environments. Then we have to face that problems, issues. Interest rate risk. In some case, the interest rates can be more fluctuations. But generally, we can observe in developed market, some particular market with the proper standard, they follow that. The other market, the changes in interest rates may be very comparatively very less. Even some other developing market or emerging market, the changes in interest rates and changes in some particular prices, that may be very high, at a very high rate. So likewise, we can observe that. Even our politicians mention that the foreign prices are very high nowadays. Likewise, sometimes not much high. Yeah, they follow some particular standards. We can observe that gas prices, oil prices can be little bit changes, but in generally, no much deviation in developed market. In the developing market, there may be much deviations, volatilities there. The interest rate also same. Then other comparative financial instruments, deposits, loans, treasury bills and treasury bonds, commercial papers, debentures, corporate bonds, asset-backed securities, lease and hire purchase, shares, those are different kind of financial instruments. So what is here? The depository, you know that loans, treasury bills and bonds, commercial papers, non-banking companies, non-financial companies issued some commercial papers, debentures or corporate bonds. Those are the corporations or public companies issued debt instruments. Another one is asset-backed securities. If the companies uh, issued some securities, they are backed by their particular assets, secured assets. Secured, we call that secured, unsecured. If they want to collect money from the as a issue some debt instruments, they can issue based on the particular securities, asset-backed securities. They maintain different kind of asset, physical assets. Backed by those assets, they can fulfill their requirements. They collect money from the people based on that particular asset. Secured, we call that secured asset. Another one is lease and hire purchases. Then shares. So depending on the risk level, here mention that particular list depending on their level of risk. Deposits, it has some lower risk. Loan, little bit more than. Treasury bills, treasury bonds, little bit more than that because of the time duration. Commercial papers, debentures, when you concern the shares. So why shares are more risks? Because there is no guarantee for their return. If the company issued some shares, no guarantee for their dividend payment. If the company earn profit, they can declare dividends, or otherwise, no declare dividend. Even if they earn some profit, sometimes they don't declare dividends, depending on their different policies. So due to that reasons, normally shares involve high risk investment. In such a case, if it is high risk, then you expect some high return. So how we get the high return? In such a case, if there are no guarantee for their dividend payment, in such a case, if I purchase that shares, why we purchase? After a few days, you can sell it at higher rate. Through that process, you can recover the more return. That is the purpose. Other one is a derivative. Their values depending on something else. Derive their values from something else, like options. Exchange rates. Exchange rate is the rate at which one currency is exchanged for another currency. Compared to Sri Lankan rupee, how much value for $1? Regarded as a currency of price. Nowadays, what is the price? Maybe 240, 245, maybe the price. But official price, maybe 205, 210 likewise. Important as international markets involve transactions in foreign currencies. The spot rate. The other one is forward exchange rate. The spot rate, the exchange rate for currencies being bought and sold for immediate delivery. If you involve some transactions on the spot, then what is the appropriate, what is the relevant rate on that particular date? That is the spot rate. Forward rate means the exchange rate for currencies being bought and sold for delivery at some future dates. If you agree with the banking company for your import some goods from foreign market, then you can make an agreement with the banking companies. In that case, you can make some agreement with the banking company. We call that forward exchange rate agreement. So how they perform that transaction agreement? Depending on the past experience, the banking company decide what is the possible price for that particular foreign currency. Then, depending on that, the banking company give you some guarantee. Now the exchange rate may be 230 rupees per dollar. Then, depending on the past experience, there can be some increase in the dollar value. Then, there can be some particular forward agreement with the 235 likewise. Then that is called forward exchange rate agreement. Because it takes some time. Sometimes if you make an order to deliver the product, that may take sometimes 3 months period. So at that time, what would be the possible forward exchange rate? Decided by the banking company. Another component is financial instrument. So financial instrument can be defined as a claim to the payment of sum of money at some future dates. So when you purchase some shares, it is a financial instrument. It is some particular agreement is there. What is the agreement? The agreement is they settle their dues at some particular future dates. When the company decide to redeem that, then they use the particular value. In other cases, the agreement can be with some particular debt. If it is a debt instrument, then that may include some compensation rate also. Sometimes that may include some particular time period also. Maybe 5 years, within the 5-year period. What is that particular compensation rate likewise? Characteristics of financial instruments. So different instruments may have different characteristics. One is risk, other one liquidity, real value certainty, terms of maturity, currency denominations, divisibility. Likewise, there can be different terms, characteristics. Risk means here the future outcome of the instrument is not known with certainty. Example, uncertainty of the price, default is of the capital or income streams. Normally, common shares, it involves some high risk, no any guarantee. Uncertainty of price. Okay. Here there is some particular agreement. The banking company, they agreed to limited to that invested money, limited liability. Another one, liquidity. It refers to the ease and speed at which a finance instrument can be turned into cash without any loss. So you can see that what is the possibility of converting your instrument into cash without making any losses. It refers to liquidity. Real value certainty, effect of exchanges of the general price level, inflation or deflation. So due to the changes in the price level, there can be real value uncertainty. Especially nowadays, price can be very important factor. The other one is terms of maturity. Financial instruments vary widely according to their maturity. Side deposits at bank have 0 time to maturity as they can withdraw on demand. So if you make a deposit in the bank, save in your savings account, then anytime the banking company give you that facility, if you ask some money, then you can withdraw that. Then their maturity is 100%. Anytime you can withdraw that. Currency denominations, the return on non-domestic instruments are affected on the depreciation of relevant exchange rates. Sometimes if the particular country issues some instrument in foreign currency. For example, Sri Lankan Central Bank, sometimes they issue some foreign bond, Sri Lanka Development Bond. Then Sri Lanka Development Bond, they issued some at some dollars, foreign currencies. Why the economy that issued that foreign currencies? Sometimes they can attract from the foreign investors. Sometimes there are some Sri Lankan reside in foreign market. Sometimes you can expect some investment from that investors. In other cases, the foreign people, they can purchase our Sri Lankan bond. Then we have to issue at foreign currency. So Sri Lanka Development Bond issued at dollars. Divisibility, the degree to which the instrument can be subdivided into small units for transaction purpose. So what is the meaning of that? Say for example, if the government issued treasury bills, maybe 1 billion treasury bills or maybe 10 billion treasury bills likewise. So if that particular treasury bills is very huge amount, then for transaction purpose, sometimes you can convert into different parts. Then you can withdraw some part of that instrument, like maybe 1 million rupee, 2 million rupee, likewise. If that convertibility options are there, we call that divisibilities. Yeah. For example, if you have saved some money in the bank, say for example, you have saved 1 million rupee in the savings account. Anytime you can withdraw any amount of money, maybe 10 rupee, maybe 100 rupee, maybe 5,000, maybe 100,000 rupee likewise. Then what is divisibility? Then there's a 100% divisibility. No? But some instruments, if you purchase at 10 rupee, you can't convert it to a small part. Then if you withdraw, you can withdraw from the total investment. So that is the meaning of divisibility. See, financial instruments available in Sri Lanka, short-term treasury bills, pre-purchase in short-term repo, reverse repurchase agreement, commercial papers, bankers' acceptances. Acceptance means the LCs. Euro dollars. What is euro dollars? Euro dollar means, say for example, US market, the currency is dollars. Now, say for example, there is some American bank located in Sri Lanka. Then, if you make some transaction with that Sri Lankan branch, then sometimes you have to make that transaction in dollars. In that case, their origin is the origin is US, but your operations are performing some other market, not from their original market origin. In that case, we call that euro dollar. Their origin is somewhere else, but transaction are taken place in somewhere else using that particular original currency terms. Likewise, there may be some other market, Japan yen, Japanese yen. There can be some particular banking companies, Japanese company located in somewhere else, not in Japan. But if you deal with that particular banking company, the yen, you have to deposit or withdraw in yen. Then that is called euro yen market. Euro yen market. So here euro dollar means outside of their origin. Then that is called euro dollar market. Euro dollar market in general outside of their origin. The currency may be dollars or maybe in yen or maybe some price pound likewise. They can be in different currencies. We call that euro dollar market. Yeah. The long-term instruments, common shares, preference shares, corporate bonds, treasury bonds, Sri Lanka development bonds, that is the in US dollars we issue, rupee loans. You can observe that particular annual report with the Central Bank of Sri Lanka, rupee loans. What is rupee loan? If the government wants some fund, they can raise the capital from the public in the form of rupee loan. We call that rupee loan. Another one is mutual fund, unit trust. Unit trust company, they can maintain different funds. They can issue some units. They can settle that units likewise. We call that mutual fund for unit trust. Deposits. Whole life insurance policy. Life insurance policies, that is also instrument. Nation building bond. In some cases, where the Sri Lankan government issued some bond, we call that nation building bond. Likewise, there can be different kind of instruments. Checks, that may be commercial papers. Every time there are alternative way. Then those alternative ways are called instruments. SEC, Securities and Exchange Commission of Sri Lanka, and set disclosure requirements for nearly all firms trading publicly. So normally, the Securities and Exchange Commission, they regulate some particular information to the public. The public company, they declare the information, but the monitoring part is done by Securities and Exchange Commission. So without making harmful to the investors, the company can declare proper announcement, proper information. In other cases, the SEC can involve that and make some corrective action. SEC also regulates insider trading, which includes trading done by directors, officers, and major shareholders of a corporation. So here, what is insider trading? So, for example, if there is a particular public company, in the same company, the directors may be a manager, or maybe an officer, or maybe one relative of that particular manager or officer. If they trade the company shares transaction activities, that can be insider trading, or that can be sometimes not the insider trading. For example, using the inside informations, if they are the officers involved in the trading activities of the same company, with the using the inside informations, that may be price sensitive information, that may be some profit level information, that may be dividend announcement information. Likewise, they may have different information. In such a case, that kind of investors, that kind of officers make some conditions. Within some particular time period, they can't trade their shares, they can't deal the shares with that in the share market. For example, if the particular public company, they make their annual reports announcement. So, for example, normally 31st March, we end the accounting year. But if they declare their annual reports 30th March, April, after 1 month after period. So if they declare their announcement, the annual reports 30th March, 30th April. So before that particular end of the accounting year, the company can close their registrations, the share register. Say for example, the 28th February, they close their share register. So during that particular period, 30th, 28th or 29th February to 30th April, they can't involve that particular share trading activity. However, using the inside price sensitive information, they can't trade their shares in the market. That within that particular period, that is prohibited. Then in such a case, if one particular director or the manager using the inside informations, if they have involved some trading activities, if one particular person can identify that and make claims against that, sometimes that may be a punishment to that particular officer or director. So that kind of things is called inside trading. So here, even if the inside directors or officers or major shareholder making some share trading activity, it does not mean that it is an inside trading. With the purpose of the gaining abnormal return using the inside information, if they involve that share trading activities, then that is an inside trading. Otherwise, insiders or directors, officers are not prohibited totally, but with some particular certain conditions, and that is prohibited. So, if they involve some share trading activities, then they have to report to the SEC. There is a requirement. So there was some particular case. In 1993, there was some case. Pure beverage company. One of the director imposed there was a particular case. Then against him, due to that particular share transfer activity, they punished, give some fine, 5 million rupees. It is one famous case. One of the director, Anna Puncheva. Now we can declare because of that particular case. All trading by insiders must be reported to the SEC. The SEC attempts to prevent insiders from secretly trading securities on the basis of private information that outside shareholders do not possess. Colombo Stock Exchange, CSE is a company limited by guarantee established under Companies Act number 7 of 2007. Policy making body, board of directors, 9 directors, Board members elect 5 directors, and the Minister of Finance appoint 4 directors. CDS is used in the CSC for dealing shares. Central Depository System, CDS provides depository facilities and clearing services for securities trading on the Colombo Stock Exchange. CDS is a 100% owned subsidiary of the CSC, Colombo Stock Exchange. Board of Directors constitutes the CD's policy-making body. Board of Directors consists 9 directors. 5 are from elected office to elected members, and 4 directors are nominated by the Ministry of Finance. Colombo Stock Exchange has about 250 listed companies. Not nowadays, there may be maybe 290 companies, 85 companies likewise. You can observe that. Represent 20 business sectors. Market capitalization as at 12th March 2008 was 835.3 billion rupees. But now you can see, you can search on the website and see what is the value now. Then another one is the market indexes. 4 indexes are all share price index, which comprises of all listed companies on the market. So in this index, we consider all the listed companies. Second one, S&P Sri Lanka 20 index. Early we started with sensitive price index, old one. Then later it was Milanka price index, Mila Saha Anka. But the girl's name, Milanka means Mila Saha Anka, Milanka. It was based on the 25 selected companies. So large companies based on their market capitalizations. Now that index we call that S&P Sri Lanka 20 index. S&P means Standard & Poor's investment company in the US market. They maintain some certain policies. So they maintain some standards. So following that standards, our large companies, based on our large companies, we can adhere to that requirement. Then we maintain that index. We call that S&P Sri Lanka 20 index. In addition to these 2 indexes, ASPI and S&P Sri Lanka 20 index, incorporating in these 2 indexes, all share price index and the S&P Sri Lanka 20 index, we consider only the stock prices, the stock price and their quantity. But for concerning the investors, investors' return may include not only price differences, that may be dividend income from the company. Likewise, the total return index includes that particular dividend component also. Then all these, the all share price index and as well as S&P Sri Lanka 20 index may include some companies declaring some dividend. So if you observe the total return index, then we can estimate the all share price index, total return index based on the all share price index. As well as we can prepare the total return index based on the S&P Sri Lanka 20 index. It means if you estimate the total return index based on the all share price index, so we consider all the listed companies and declare some dividend. That particular dividend component also incorporated in that index. Then we call that total return index. In other case, if total return index are estimated based on the S&P Sri Lanka 20 index, and then that particular 20 companies may declare sometimes dividends. In such a case, incorporating that kind of company's dividend declarations, we prepare that index. We call that total return index based on the S&P Sri Lanka 20 index. The difference is the total return index includes the dividend declaration also. But in all share price index or S&P Sri Lanka 20 index include, we don't consider the dividend payment. The dividend component also one part of the investor's income. Get the idea, and then S&P Sri Lanka 20, the only share market in Sri Lanka, Colombo Stock Exchange, in collaboration with the Standard & Poor's indices, has launched a new index to meet the investor demand for a transparent, rule-based benchmark to measure the performance of Sri Lankan equity market. The new index S&P Sri Lanka 20, jointly developed by the S&P indices with the SEC, is designed to representative of the Sri Lankan equity market, but be efficient to replicate with possible applications of index funded funds and ETS. Press release issued by CSC 19 June 2012. Index include the largest 20 stocks by total market capitalization listed on the CSC that meet the minimum size, liquidity and financial viability threshold. The index has been created to help both local and international investors to gauge performances of the Sri Lankan equity market. So these are the requirements and these are the purpose. Then understand that there are two main index, all share price index and the S&P Sri Lanka 20 index. The S&P Sri Lanka 20 has been designed in accordance with the internal practices and standard. All stocks are classified according to Global Industrial Classification Standard, GICS. The index employs a transparent, rule-based methodology, adjusts for available sort and employs inclusion thresholds necessary to enhance tradability. To be included in the index, a stock must have minimum sort-adjusted market capitalization of 500 million rupees. A 6-month average daily value traded at 1 million rupees. Should have traded at least 10 days of each month for the 3 months, and a positive net income over 12 months prior to the rebalancing reference date. So these are the requirements. They consider the last 20 companies, but they concern these requirements. All share price index are estimated market capitalization of all listed companies. It means the market capitalization means price and quantity. Market price multiplied by number of shares traded by all listed companies divided by base market capitalization. Then there is a base year. Base market capitalization, number of shares at base year 1985 multiplied by base market price. So we compare the base market year, base year and their prices, and what is the current prices and their quantity. So what would be happen if one particular company, now there is a new company listed in the market, but it was not available in 1985. Then normally, practice is we consider the market capitalization of all listed companies here, including all these companies, price and quantity, and then divided by in 1985 base year price and their quantity. If that particular company, if it was not available in 1985, then we make an adjustment to the base market capitalization when they introduce the shares to the public on their very first day, how much the value was there, their price and the quantity. It is the base value. In addition, we have to concern about the world recognized indexes, market indices, Dow Jones Industrial Average, DJIA. Then another one is S&P 500 index. Dow Jones Industrial Average is based on the price of 30 large, well-established companies. Dow Jones company, they prepare their index, they consider only prices of large 30 companies. Dow Jones Transportation Average, Dow Jones Utility Average. So in that index, it consists of some companies from the transportation sector, some other companies from the utility sector. So Dow Jones Transportation Average, this is based on 20 major railroad, airline and trucking stocks companies. Dow Jones Utility Average, this is derived from the prices of 15 large major utility stocks. This is based on the combination of Dow Jones Transportation Average and Dow Jones Utility Average. Then S&P 500 stock price index, we call that is short for S&P 500. So 500 means here number of companies. This is a broader index than the Dow Jones Industrial Average. It is derived from the prices of 400 leading industrial firms, 20 transportation firms, 10 utilities, and 40 financial institutions. So this is the broad index, which means that their value decided based on the stock prices as well as number of shares traded. Those 500 companies, prices and the quantity. So if you get some idea about the world market operations, 10 largest banking companies, 10 leading underwriters. We can just go through that. 10 largest banking companies: Citigroup, US, Dutch Bank, Germany, Credit Suisse, Switzerland, BNP Paribas, France, Bank of America, US, JP Morgan Chase, US, UBS, Switzerland, HSBC, UK, Mizuho, only Japan, Fortis, Belgium, Netherlands. 10 leading underwriters: Citigroup, Goldman Sachs, Lehman Brothers, Morgan Stanley, Credit Suisse, Merrill Lynch, Dutch Bank, UBS, Bear Stearns, Bank of America Securities. So in addition, there can be some other particular finance sectors. So you have to concern about that. Some Swiss banks, normally they operate transactions without declaring any information to any parties. So think of that kind of things in financial hubs. What else? The available market or banking sectors in world market. These are the things we have to cover within this particular discussion. Financial environment. practically there can be more interesting areas, more important factors that are concerned about the operations. So we must know whatever the subject we follow, this part is very important. If you are a finance manager, if you are a CEO, if you are some other manager, if you are some particular individual person, this discussion is very important. We must aware about our environment. If you have any questions, now you can raise. By next week, I think Dr. Champa will take the task, starting from the time value of money. So later, I will take some other topics concerning the corporate financing. So in the meantime, there is some particular midterm exam. Now already we have covered 2 sessions. After several weeks, we have a midterm exam. Remember that, maybe in 7th week or maybe 6th week. If you have any issues, please inform us early. So if you don't have any question, now we can stop. And thank you very much for listening the lectures.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Okay, thank you.
Thank you, sir.